Intentional grounding in football. 15-yard penalty. Loss of down. If the quarterback isn't outside of the tackle box, the ball doesn't get back to the line of scrimmage, or it's not thrown in the direction of an eligible receiver. Personal grievance. The spike that quarterbacks do, that teams do in order to stop the clock because they don't have a timeout. It should be an intentional grounding penalty. It is, by very definition, an grounding of the ball intentionally. But then let's go to the rules. The rules say quarterback has to be outside the tackle box. Well, he snaps the ball, he throws the ball to the ground. Not outside the tackle box. Not directed at an eligible receiver, because as far as I know, the center cannot legally catch a ball unless it's been tipped or batted, all kinds of different rules there. Not outside the tackle box, not at an eligible receiver, and it lands behind the line of scrimmage. So it checks all the that's a penalty boxes, but we let them do it. Bugs me. Anyway, this isn't a show about how Mike can't change the rules of football. Welcome to Covering HOAs with One Hot Mike. Today we're going to talk about the 5 main insurance policies for condo association, single family home association, potentially even you as an individual, but we're really focusing on the HOAs, hence the title. Insurance can obviously be confusing. Some people might say it's boring. I don't think so, but some do. Some might call it a cure for insomnia. I think it's wonderful. And fortunately or unfortunately, it makes sense to me. Understanding insurance, you might first assume for a second a world in which insurance doesn't exist. If we have a piece of property and we have a risk of having to spend money to fix that piece of property, then we have to find a way to manage that risk. That's called risk management. We can avoid risk. If we have a tree that we're worried about falling and landing on a car or a building, we get rid of the tree, we avoid the risk. We control risk. We do property maintenance, regular property maintenance, proactive maintenance. We do things like maintain the roofs, repaint the buildings, replace roof coverings, shingles, what have you. We grind down concrete spots that might be a trip hazard. That's how we're controlling the risk. And then we have to accept risk. So that leaves a lot open, right? Accept risk. What about our community is a $10 million, would cost $10 million to rebuild. I don't have $10 million in the bank. What do? Well, I can transfer the risk, and that's insurance. Insurance is the transfer of risk from you, the risk that you have, that's why we call it a risk, to the insurance company. Now, the insurance company accepts some, not all of the risk, because if they accepted all of the risk, they'd own the property. So what would be the purpose? And they don't want all the risk. They just want to transfer some of the stuff so that we can feel better, so that we can transfer what we can't really anticipate. Because if we could anticipate it, we should be controlling it or avoiding it. And then there's still some things that they're going to say, you still got to accept that. Because again, you could have probably controlled it. You maybe could have avoided it. But it's just something that we're not going to accept the transfer of. That's what an insurance policy is for. And the insurance policy lays out the things that an insurance carrier is accepting the transfer for. Things like fire, things like water damage from a burst pipe, things like wind. In a liability situation, things like a trip and fall allegation. So those are the things that are transferred from us to the insurance company. And property ownership can be expensive. So implementing a good risk management practice will help avoid, will help control, will reveal the things you can transfer, and will limit the stuff, minimize the stuff, the exposures that you need to accept. When we transfer in risk or when we buy insurance, there are 5 main policy types. There's property insurance, general liability insurance, directors and officers liability insurance, crime, fidelity bond, fidelity insurance, and workers' compensation insurance. Those are the 5 main ones that we're going to talk about today. So the first major kind of policy is a property insurance policy. Accepting the cost to repair damage to property can be difficult because it can be expensive. So transferring that risk to an insurance carrier reduces our exposure to financial loss, to the premium we have to pay, and the deductible. I'm Mike Headroom right now. Deductible reduces our risk down to just the premium we pay and the deductible that is on our policy. Not a bill. It's not a chargeback. It's not an invoice. It's not a deductible. It is an amount of the covered repair cost that is deducted from the payment of the claim. That's why we call it a deductible. We deduct this amount, and the insurance company deducts this amount, and we get a check for the net amount of the covered loss. Then we, the insured, are going to have to figure out what we're going to do with that. We're going to pay it ourselves. We're going to use a credit card. We're going to ask Uncle Eddie, who's rich, to help us out. Who knows? But that's our burden, because we transferred everything else to the insurance company except the premium. That's what we paid to get the transfer, and the deductible. That's what we accept as part of that agreement. Now, the carrier doesn't accept all the things. Folks, insurance world calls it a peril, not a peril, but a peril. Essentially, there's so many perils that the insurance company covers. That is, the insurance company covers the property for damage caused by these events, these perils. They only list the things that they don't cover for, the things they exclude as perils. Earthquake damage, flood damage, property settlement, mold, rodent and insect damage, wear and tear of a component. That's not covered. That's a maintenance thing. You should have controlled it. Oh, my roof is leaking. Well, when was the last time you had somebody look at your roof? I've never had someone look at my roof. How old is the roof? I've been here for 40 years. Oh, well, maybe you should have had somebody look at your roof and make sure there weren't any holes. We want to avoid risk as much as we can. What we can't transfer, we ultimately need to accept. If we have one of those perils that is excluded, we go looking for a policy so that we can transfer that specifically. It's not covered on this main policy. It's excluded here, but we're going to cover it by purchasing a separate policy for that peril. We call it monoline. Interestingly, water itself is excluded on a policy, but we add back coverage for sudden and accidental discharge of water from a plumbing system contained within a building, a burst pipe. Some carriers also add back coverage for damage caused by sewer and drain backup, though many times that's a limited coverage. It's called sub-limit. So if we have $1 million property insurance policy, we may have $100,000 worth of coverage for backup of sewer and drain. The second main type of policy is a general liability insurance policy. Property ownership involves exposure to liability. If we hurt someone, if someone is hurt on our property, or if we damage someone else's property, we could be seen as negligent. We could be responsible for paying the expense that other person incurs. They're the third party. We're the first party. We're the insured. That other person is a third party, somebody else. The second party is the insurance company. Allegations of negligence typically come in the form of a legal action, maybe a threat of legal action, or even an attorney's letter. And hiring attorneys can be expensive, to say nothing of judgments and settlements. So we purchase general liability insurance to transfer the risk, the financial risk, to the insurance company. If we cause injury or harm to another person, or we damage property, the insurance carrier will pay for our defense and cover judgment and settlement if the allegation of negligence is covered and we were indeed negligent. Now, negligence is a tough word. It's a hard word. It's a harsh word. It sounds terrible, but it's the only one we got. So we're going to use it. General liability policies for condo associations, single family home communities, HOAs, are written on an occurrence form. This means the policy in force when the claim occurred is the one that is used to address the allegation. For example, if someone trips and falls on a sidewalk a year ago, we didn't know about it. The association in that time has changed from one general liability carrier to another, and then that injured party informs the association. The claim is tendered to the previous general liability carrier, the one that was in place when the claim occurred back in time with Marty. Coverage is generally broad in scope. The main exclusions are known wrongful acts or any sort of professional liability. But by and large, general liability is going to cover a lot of stuff. The next main policy type is directors and officers liability insurance, or more specifically, directors and officers errors and omissions insurance. This is purchased to transfer the financial exposure due to allegations of negligent decision-making by the board of directors. The insurance carrier agrees to pay claims to the insured for all loss it becomes obligated to pay as a result of the claim. Like general liability, the scope of coverage is very broad. The main exclusions are known wrongful acts, bodily injury, property damage. That's covered on your general liability policy. Or incidents you knew about but didn't report to the insurance carrier. Unlike general liability, directors and officers insurance, directors and officers liability insurance, let's do this right, D&O, because that's how we abbreviate. D&O is written on a claims-made policy form. That means that the policy in force when the claim is made is the policy that is used to address the allegation. For example, someone agrees to, or someone alleges that the association's board breached its duty of care, and that stems from an event that occurred before the association changed insurance carriers. The claim is reported to the current insurance carrier. It happened when carrier A was in place. We changed from carrier A to carrier B, and now we were informed about it when we're with carrier B. So we're sending that to carrier B. Important to note that most carriers have evolved their policy language not to be just claims made, but to be claims made and reported. If a claim is made to the association, it needs to be reported to the carrier during the same policy period. Otherwise, you may not get coverage. There is some leniency in that, extended reporting periods, but it just really underscores the need to file your claim or contact your professional, whether it's your legal counsel or insurance broker, as soon as possible, because you receive something that might be a claim. And in my experience, if you're asking the question, hey, should we send this to the carrier? The answer is going to be yes, because it just makes sense. It's just the right thing to do. An association that receives a claim made in one policy period and then doesn't report it to another policy or in the other policy period may not have coverage. And D&O claims get really expensive because there's a lot of legal fees. Important distinction, a claim is someone's allegation that you breached your duty, that you did something wrong. They claim you breached your duty and they demand that here's what I claim you did this to me and this is what I think it's worth. And then we as the insured have to report it to the insurance company. So the claim is not us reporting to the insurance company. The claim is coming from someone else and we receive that claim and report it to the insurance company. Another important aspect of D&O insurance is that most carriers offer defense costs outside the limit of liability. Outside the limit means the defense costs are addressed separate from the policy limit. For example, if you have $1 million insurance policy. Defense costs in a claim might be $300,000, and you get $1 million judgment issued against you. The full judgment will be paid, that full $1 million, because you have $1 million policy, and the $300,000 defense costs were covered else, were addressed by the carrier directly. They don't eat away at the money that you have, the policy limit. Contrary to that is inside the policy limit. So take that same claim. We have $300,000 worth of defense costs, and we get issued $1 million judgment. If defense costs are inside the policy limit, we take $300,000 of our $1 million, our $1 million limit, we pay defense costs, and now we only have $700,000 to pay $1 million judgment. So we really want to look for D&O coverage that has defense costs outside the limit of liability. Those are actually potentially going to become rare, if not disappear altogether in the relatively near future, because defense costs have skyrocketed so much, because a lot of attorneys have figured out how to work the system, if you will, that carriers are either limiting defense costs by saying we have $1 million policy limit for judgments and we have $1 million for defense, or just bringing the whole thing back inside the limit and saying you have $1 million policy limit and defense costs are inside that limit. That's something that we're going to probably see relatively soon. A policy that I didn't mention at the beginning is one of the 5 main: umbrella or excess liability insurance. This is just a way to buy more liability insurance to go over your general liability and the D&O. So, for example, I have $1 million general liability and $1 million directors and officers liability, but my CC&R says I have to have $5 million of per occurrence liability in place. Well, I can buy an umbrella, a $4 million umbrella policy, and it will cover both of those. If you ever see an excess liability policy, it's only over that specific policy. So I have a general liability policy and then an excess general liability policy. Gives me more liability insurance, but just for the general liability. The umbrella is broader, covers both. The use of the umbrella is a very good way to buy a lot more insurance for a very small price. Some states have regulations that require a certain limit of liability be in place. Up to 100 units, we need to have $2 million of per occurrence general liability in place. 100 units or more, we have to have $3 million of general liability in place. Lots of carriers, very few, I should say, carriers offer limits higher than 2 million. So if we are a condo community of 500 units, we need to have at least $3 million of coverage. The only way to get there is to buy an umbrella policy. It also helps with whatever our risk tolerance is as a community or as a board, because that's a minimum limit, but maybe we want more because we have, let's say, 5 pools, a water slide, a lake that people are allowed to swim and boat in. Those are all bigger liability exposures, and we may want a lot more insurance than just the minimum that's required by either state legislation or our governing documents. The next main policy type is crime fidelity insurance, or a fidelity bond. And this is coverage for money the association has in the bank. It used to be literally a bond. It was a piece of paper, just like you would buy a bail bond. Bail bond is the same thing. I give you money, you give me a piece of paper that's worth X amount of dollars. We have increased the ways that a bond would be used or needed, and ways money can be lost. So with the ever improving skill of hackers and thieves, insurance policies are purchased to define and narrow the types of losses that are covered. Coverage limit is arrived at a simple calculation. Typically, the requirement is 3 months, an amount that is at least equal to 3 months assessments plus reserves for the community. I like to add in the budgeted figure that the association is going to be contributing to reserves on an annual basis. Reason being, if 3 months assessments plus our reserve balance at January 1st is $100,000, and we don't use any money from reserves, but all we're doing is contributing $1,000 a month to reserves, then by November we're at $111,000. And if someone's trying to close a loan, that's going to slow things down. It's not a big problem. It's really simple to fix. It doesn't take a lot of time, but it just looks bad. It looks bad on the manager. It looks bad on the broker because this homeowner is either trying to sell or refinance and we're getting in the way. So I say add in this little contingency, add in the budgeted figure for reserve contributions for the year. We evaluate it every year. And so if we see that the reserves haven't changed, then we don't need to change the limit. Premium doesn't go up. The cost of this little amount with respect to the entire cost of the fidelity bond is minimal. And the fidelity bond, the crime policies premium is minimal to begin with. So put that little bit in there. If the state legislation or your governing documents differ from that 3 months assessments plus reserve, because that's the lending institution. Those are the mortgages and the banks. That's the one they want, 3 months assessments plus reserves. Typically the CC&R says the same thing. But if it has something more conservative, it says 150% of annual operating expenses, or state legislation has some more conservative figure, you need to use the higher number, because the higher number keeps you in either in compliance with the state regulation or with the governing documents. Sublimits in these policies vary by line, but coverage is provided for the theft of funds, forgery and alteration, theft of cash on or off premises. So if you have like a clubhouse and you have on site and somebody holds money in a safe, that money is insured to a certain limit. Computer funds, wire transfer funds, funds transfer fraud, money and counterfeit currency, as well as fraudulent impersonation. Ooh, that sounds scary. One note, the association, the insured, needs to do all the forensic accounting to prove the loss. They also need to file a police report, because the insurance company is not going to just believe somebody wandered off with your $100,000. They want to see the backup. They want to see the documentation. And if you want that money back, police are going to need to help. So you have to do all of the forensic accounting. The carrier will review, make a coverage determination. And that window to report a loss closes over time. So keep track of your financials. Review your financials monthly. You should be doing that anyway. Don't have the same person who reviews the financials be the one who handles the finances. That's silly. If you have an opportunity, separate those duties. That protects the association. And there's a growing concern for cyber theft and cyber liability. As we're moving closer and closer to a completely digital world, hackers are getting better and better. Cybercrime is becoming an exposure for everyone, not just an association or a management company that holds owners' information, personal information, payment information in their database. So the purchase of a cyber liability or cyber theft policy is becoming more and more important. It's becoming more and more common to transfer that risk of monitoring these things to the insurance company. Policies do come with certain safeguard requirements, so you need to be diligent about what the carrier is requiring you to do in order to, wait for it, control the risk before they accept the transfer. So they may say you have to have 2 signatures. You have to have, you can't have a signature stamp. You have to have the document, again, the financials compiled by one person and reviewed by another or approved by another. Those are ways that a carrier is going to be more comfortable with accepting the risk, because they don't worry as much that there's actually going to be a loss. Finally, the last main policy type is workers' compensation. Now, if you have employees in your association, you've got a work comp policy. Can't have employees without a work comp policy. It protects the association against medical expenses if employee is injured in the course of their work. For associations without employees, it's actually best practice that they carry a workers' compensation insurance policy. We call it on an if any, that's the proper use of these, by the way, if any basis, meaning if there's anyone that is deemed to be an employee of the association, or if there's any occurrence in which the association is deemed to be the employer of an injured party, then we have a work comp policy to fall back on. It's not first dollar insurance. That contractor that gets hurt while doing their job, that contractor is going to their workers' compensation policy first. If the work comp carrier declines the coverage, it's possible that's because the carrier viewed that employee or that person, that individual, as an employee of the association at the time of the loss, time of the injury, and therefore we need to go to the association's work comp policy. Is it rare that an association be deemed an employer? Yes. But it's real. And it's happening more often. And it doesn't have to be a contractor. It could be anyone. Let's say we put together an ad hoc committee to clean up the community, do a little spring cleaning of the common area. We have a list of folks that have signed up to be on this committee to help come around and clean up. And somebody during that event, during that day gets hurt. They tweak an ankle, sprain an ankle. And they say to the doctor's office or the ER, the urgent care that they go to, because on your intake forms, they always say, was this a work-related claim? And they say, well, yeah, I think I was working for the association. I was volunteering, but I was working for the association on association property. There's potential their health insurance carrier would say, not covered. That's a work comp claim. A potential. It's rare, but it's real. The other one is a contractor working outside of their scope. Well, there's obviously the contractor whose work comp policy goes out of force for some reason and we don't know about it. And then he's injured. That contractor or the contractor's employee is injured while the policy is out of force. Well, that's not going to be covered. And the Work Comp Appeals Board is going to find a pocket to dig into. That's going to be the association. The other contractor exposure is a contractor working outside of their scope. So let's say we have a painting contractor and the painting contractor is up on a ladder, leaning against the wall, and he is just 2 floors up, and he's getting ready to paint the wall, and somebody walks by and says, hey, while you're up there, if you wouldn't mind cleaning out that gutter, I noticed it's been clogged and it's not draining right. So if you could clean that out just because you're up there, that'd be great. Employee says, sure, why not? I'm here. Reaches into the gutter to clean it out, doesn't realize that there's a loose electrical wire hanging down, touching the metal raid gutter over here. So as soon as that contractor touches the gutter, he's electrocuted, thrown off his ladder. Contractor's workers' compensation insurance carrier says that's not covered because that person was not an employee of you, the painting contractor. That person was an employee of the association. He was a maintenance man for the association at the time of the injury. Rare, but real. Insurance is possibly the most valuable aspect of risk management. It moves the risk of financial loss to someone else for a small amount of the exposure that we have. We have a $10 million exposure. We could pay as an association $20,000 in premium to avoid having to accept a $10 million loss. Insurance forces business decisions, not emotional ones. And it allows us to allocate funds to projects that will help control or avoid risk, which then limits what we need to accept. And that's really just good for everybody in the community. Before I leave you today, please do like, subscribe, share. I'll leave with this. You control what happens in your world. You control how you respond to events that take place. You control whether you are able to be successful, are able to succeed, are able to grow. We don't learn from winning. We learn when we fail, because that tells us, that helps us figure out how to do it better. That helps us grow. And if you don't think that's true, life's battles don't always go to the stronger or faster man. But sooner or later, the man who wins is the one who thinks he can. Go out there, be the little engine that could, and show people you can. Thanks for hanging out. Come back, check us out again on another edition of Covering HOAs with One Hot Mic.